Hello everyone, Dave Landry here from DaveLandry.com. This is Trading Simplified. So what are we talking about? Well, like I said, last couple of weeks, we've been working on these 22 trading resolutions for 2022, and we're going to get to that. But I think it's important for me to show the state of the market based on potential downtrend we're in and sell signals. So I want to follow up on that briefly. If you want more information on that, go in and watch last week's presentation, or as you'll see in 1 second, ask for the slides and I'll give you a market timing course. So I do want to show you the methodology in action, and lately it's been mostly shorts or nearly entirely shorts, and I think that's important to see. And then of course we'll get to those resolutions. Housekeeping, I do take requests. You can send them to davelandry.com/contact. It makes my job a lot easier if you tell me what you would like me to cover. That way I know ahead of time. Also, if it doesn't fit into this particular show, which has some limitations as far as time and such, I can cover it in my weekly show, davelandry.com/webinar for more information on that. Register even if the date is old. These shows, as you know, right now aren't live thanks to COVID, but I'm continuing my week of charts live. So you can attend those shows. And most weeks, every now and then I'll take a week off, maybe next week because of the holiday I won't be there. But anyway, most Thursdays at 7 o'clock Eastern time. I'd love to have you. Send me your questions ahead of time, ideally, but feel free to pop in and ask me questions on the fly. I'm pretty good with that too, but it's a lot easier if I have time to put together a couple of slides to answer your question. Anyway, davelandry.com/contact for that. If you want the slides from this presentation, the aforementioned market timing course, and enough stuff to keep you busy for a long time, including all three of my books in PDF format, davelandry.com/StockCharts. All right, let's talk about the mystery charts and the methodology in action. Here's this week's mystery chart. Notice at the bottom, it's a sell short, entry 116, stop 124, initial profit target 108, 8 points of risk. Now, there's a lot of mumbo jumbo out there when it comes to technical analysis, and I think it's just that, mumbo jumbo. The reality is, if you're using technical analysis from the purest standpoint, you're just simply looking to read the emotions of the market. Now, at a new high, what happens? Anybody who bought the stock prior to that new high is making money and feeling pretty good. Now, you can see this little red bar here. Obviously, anybody who bought above this close is already losing money on the trade. And as the stock drops, more and more people are now losing money and maybe looking to get out at break even, or maybe just bail if the selling becomes too much for them and they need the money. But you can see that it did pull back a little bit, and that gives people a bit of false hope sometimes, if it turns back down, of course. And that's why a pullback works. Not all the time, but sometimes. So nice little pullback here, entries here, stop is up here, initial profit target is down here. One other thing I wanted to show you is notice that this stock persists in its downtrend, or has persisted in its downtrend, meaning that it tends to go down day after day after day after day. Mathematically, you can plot this with linear regression, or as I like to do, I just draw a trend line through as many bars as possible. So this becomes a bit of like a Chinese water torture to people or investors or traders, whatever you want to call it, people who have bought the stock, especially as it drops more and more and more. Every day they come in, the stock's dropping more and more and more, and the pressure begins to build. They get a little relief rally in the pullback, and when it turns back down, they might be looking to bail out. So that's the whole premise there. Same sort of thing happened with Papa John's. This was the mystery chart from last week. It made a bow tie to the downside, sold off pretty hard and pulled back. The parameters are down there. So nice little thrust down, and the bow tie, meaning that the moving averages came together and spread out. We'll talk a little bit more about these in 1 second. But you can see almost all-time highs at this level here. So I like the bow ties on the short side when they're at or near or coming off of all-time highs, I should say. And again, like the prior setup, pulls back, entry here, initial profit target down there, stop up here. And let's take a look at what happens. So here's our entry. Notice that the stock rallies up and kept on rallying. And it also started pushing into all of this overhead supply. And I decided that the setup wasn't worth it. It still looked okay, and you could see it actually sold off a little bit from those levels. But in explaining why I took this off, you got to realize that there were also a lot of other stocks setting up on the short side. There were a plethora of stocks. And I like using that word because a lot of you guys tell me that it means a lot. Anyway, let's follow up on T and DM. This was not a mystery chart. It was not a mystery chart because we triggered into it, and then I showed that as a stock that we were short, and it looked like something that might have been worthwhile. You could see when I initially showed it, it was losing money. It was failing miserably, but we followed the plan, and we stuck with it. So let's take a look at that. Again, all-time highs, big slide. So obviously you're seeing the same pattern beginning to evolve. A little bit of a pullback. We shorted it here when it was beginning to slide. Now, obviously, we didn't know at the end of the day it was going to end higher. We thought it was just going to keep on dropping. But we have a stop in place just in case. And fortunately, it did sell off nicely. And we were able to get our initial profit target out of the position. So if you take a look at the spreadsheet, you can see we got a little bit more than $1,000 on a 100K account, which is the hypothetical portfolio, is based on a 100K account, I should say. You would have made $1,000 on the first half of the position. And the second half, we are hoping, I know you should never use the word hope, but we're hoping to ride the trend for a long, long time. For instance, you can see this ARLP is up 200%. We initially took the $1,000 off when it was up about 20%, and we're going to hang on until we get stopped out and see how much money we can make on the second low. Now, in this case, unfortunately, it did stop out. So that $573 that we were hoping would turn into a lot more evaporated, and we got stopped right about where we entered the stock. So we made zero on that. But you know what? 1% in about a week's worth of time is better than a poke in the eye, is what I say. So again, we sold short here. We exited half here. And then once you hit your initial profit target, your stop is brought down to break even. Go in and watch the shows we've done on money management for a little bit more on that. So again, better than the poke in the eye. And the short side can be tough. A lot of times, as you likely know if you've been trading for more than one day, especially on the short side, shorts will take off and it'll be fantastic. Then, unfortunately, they'll have a sharp retrace rally. And then, of course, a lot of times they'll roll right back over. As I've been saying quite a bit, last summer when the market was making all-time highs, I decided to do a show on market timing. And the reason I did that is no one calls me when the market is doing well at or near all-time highs. They call me after the market drops about 30 or 40%, and they're in a bit of panic, and they're asking me what to do. And I'm like, well, it's kind of darned if I do and darned if I don't. By that time, the bottom's already blown up, right? So it's a little bit late. So you really have to get ahead of market timing. Now, I came up with this simple little system. It just amazes me that it works, but it actually works pretty well. And by the way, as I preach, market timing is less about beating the market, at least the way I see it. It's less about beating the market and more about not letting the market beat you. So you won't be in a panic when the market's down 30 or 40% because you got out when the market was down about 10%. If you have to get back in, no worries. As I quote Greg Morris ad nauseum, he was visited a few years back and we got to talking markets. And he said, well, Dave, whipsaws are frustrating. Bear markets are devastating. You could survive frustration. So it was a little frustrating that the signal re-entered about 2% higher than it got out after the pandemic. But you would have gotten out before the market slid another 30%. And believe me, losing another 30% after you're down 10%, pretty hard to sleep at night. So anyway, my premise with this system is as long as the market is within 10% of all-time highs, it's in pretty good shape, okay? Or at the least, it's okay. Anytime it gets more than 10% away from all-time highs, it could be in trouble. Now, you can see right here, we had all-time highs a couple of months ago. This is a weekly chart, by the way. And if you take 90% of that, that gives you what I call the buy line. And as long as the market is above that, again, you're okay. So when this histogram down here goes above 10%, you would obviously be below the buy line. Both of these parameters are set the same, 10%. And you can see we did bounce off the buy line so far. Now, keep in mind, a signal is not when you cross the buy line, but when you close below the buy line. And the other part of the sell side of the signal is you also have to close below the 50-week moving average. So since the buy line is below the moving average, any close below, and I don't know if you can read that or not, but that's 42.89.50. So let's just say 42.89 round numbers would be concerning. So write that down. Keep an eye on those levels. And if the market goes on to make new highs, then we have nothing to worry about. If we close below those levels, the market could be in trouble. So you might want to consider some evasive action. Now, notice if you take a look at the bow tie moving averages, 10 simple, 20 exponential, 30 exponential. And by the way, I don't call these indicators, I call them illustrators. It helps to illustrate what's happening in the chart. So you can see mostly green. Yeah, market looks pretty good. Mostly positive upward movement, meaning that the bow tie moving averages remained in mostly uptrend proper order, 10 greater than 20 and 20 greater than 30. That's all this illustrates down here. If they're chopping back and forth, it turns green. If they flip to the downside, they turn red. So this is just a daily chart with the bow ties plotted. And again, I don't like to use indicators, but I do occasionally use a moving average or two as illustrators. And this does a really good job letting me know the state of the market. But you can see when it turns red, market gets a little iffy. You don't necessarily want to rush out and sell the farm, but you might want to have it appraised when that happens, right? And then we were mostly green. Although it was a choppy uptrend, the market did, for the most part, work its way higher since it turned green again. And then obviously now we're back to red, and that's a little bit of a concern as long as the bow ties stay in downtrend proper order. Now, as I said ad nauseum, the weekly signals here are pretty amazing. In 2000, everything was going great. We were in a nice bull market. Then what happened? A little bit into 2000, they all turned red on a weekly chart, okay? We had a bear market, then they turned green, or mostly green. We had a really, really, really nice bull market. What happens in 2008? Well, they turned red and stayed red, and that was a bear market. So you can see this can really help to keep you on the right side of the market. The only issue is there are times when using a slower system like this, a system that has lag sort of built in by design on a weekly chart, things can turn a little slow. So as I would say quite a bit, we've been green all the way since last July or so, and that's been a pretty good run, okay, so far. And we're still green, even with this little spill that we recently had. So that's bullish, at least based on this kind of a longer-term timing type of signal. But notice during the pandemic, by the time everything turned red, it was too late. So if you get a gradual rollover in the market, and if the market right now, God forbid, is having a gradual rollover, then you will get a signal in this longer-term trend following signal. By the way, the TFM 10% system triggered right here, and this is the 30% slide that I was talking about that happened afterwards. And then, of course, like I said earlier, you would have had a little whipsaw. You would have gotten back in probably about right here, which is above where you got out. But here's the thing. As I say quite often, it's a lot easier to sleep being out of the market doing that 30% slide than it is if you're in the market. So market timing, again, less about beating the market, more about not letting the market beat you. Now, one of my favorite moving averages, I know you probably want to party with me, is a 30 EMA. And I like to look at Landry light, and that's just highs less than the moving average, or some people like to call it a gap below the moving average. I think the candle people call it a window. Whatever you want to call it, you can see that the highs are less than the moving average. And this illustrator down here just tells you what's happening. So when that turns red, the market could be in trouble. And obviously that was the pandemic slide. Now, it's been mostly green for a long time. We had a little red here and there. Again, you don't necessarily want to rush out and it'd sell the farm until of course you get a major signal like the bow tie moving averages flipping over on a weekly chart or a TFM 10% sell system. But when it turns red, be a little cautious, and as long as it's mostly green, then stick with the longer term trend. You can see a little red back here when the market got a little iffy. And then now we've been red for quite a while. The market did rally up to the 30 EMA, which resets the red to 0, okay, but no green because you don't have any lows above it. So if the lows get back above the 30 EMA, then maybe we dodged a bullet here. But pay attention to the Landry light, and this is a simple little way to stay on the right side of the market. So again, lots of red as of late. I'm mostly red for quite some time. So market could be in trouble. All right, let's get back to those trading resolutions for 2022. Now, when we left off, I talked about keeping a trading journal. And one of the things you want to really do is you want to identify bad behavior. Obviously, you want to record your trades, but you also want to really talk about your emotions, your feelings. One of the things that I discovered, one of my problems, I should say, is that, especially with this intraday trading that I do, which is a little outside of the core methodology, but one of my problems I discover is I'll go eat lunch and I come back to work and all of a sudden everything just looks absolutely fantastic and I find myself in a bunch of mediocre trades. Well, it dawned on me that maybe before lunch, I was a little hangry, needed to eat, okay, and then after lunch, I was feeling pretty good. So whenever I walk into the office, the first thing I do, and this is one of these commitment devices that we'll talk about in upcoming shows, is I will write down WITO, walk in the office, and what time I walked in the office. And any trade that I go to make after that, or immediately after that, I should say, I'm like, well, just hang on. Let's just see what's going on here. And as I said recently in quite a few of these shows, there's been judges who give much more lenient sentences after lunch than before lunch. So if you ever get into a lot of trouble and you're guilty, make sure that judge has lunch before he sentences you. And it's very unfortunate, but it is what it is. So you got to be really cognizant of your own emotions. Now, another thing with a trading journal, especially as it relates to emotions, as L.R. Thomas once said, don't expect trading to fill a hole missing in your life. And the bottom line is there's always going to be something missing in your life, whether it's a want or a need, or you might have a loved one that's not doing too well, or whatever the case may be. So you've got to be really careful not to let those things creep into your trading. And the more you document as I preach, the better off you're going to be. And as I've said 1,000 times, do your morning pages. Get up and write for, it should take you maybe 30 minutes. It takes me a little bit longer, but at least 30 minutes of your time. Allocate that to just write 3 handwritten pages. And you're going to be surprised at what comes out in those pages, how you feel, whether you drank last night or not, or whether you slept properly, and so on and so forth. And a lot's going to come out from those pages. And that's going to really, really help. And it can be painful at times, but it's really going to help with your trading because you'll have a lot of introspection. And it'll force you, in some cases, if you're losing on your trades, and you come in every day and you're complaining about that, then you might be Einstein's definition of insanity, doing the same thing over and expecting a different outcome. And believe me, I am often guilty of that, and that's why I do these pages, and I'm very cognizant of those bad behaviors. Number 19, I will believe in what I see and not in what I believe. It's very hard, if you're long or short a market, to see things clearly because obviously you have a bias. As Mike Tyson or his manager once said, everyone has a plan until they get punched in the face. You have to seek truth when it comes to markets. And it's very hard to seek truth when you're on one side or the other. But there's only 3 states in which a market can exist. And you have to remember that. There's either demand, supply, or equilibrium where demand equals supply. So you always have to truly ask yourself what it is. It may not be what you want, but unless you're Bill Clinton, what is. And believe me, it could be tough not to let perceptual distortion or selective perception kick in. Those are 2 things that I've talked about quite a bit when it comes to trading psychology. And that just means that if a market is going up and starts selling off, you're going to reason why, either through selective perception. You're looking at an uptick as it begins to roll over. You're looking at upticks like, oh, there it is, it's fine, it's coming back. Or you might be perceptually distorting the data to kind of fit your narrative. And you got to be really, really careful about that. Number 20, I will read my 3x5 card before each and every trade. This is what my 3x5 card looks like. I, Dave Landry, will take the best ogre and trend trades, even if this means passing on an okay opportunity and watching them occasionally take off without me. Now, there's a lot of neurology involved in this. As simple as it sounds, reading that stupid little card does occasionally stop me from doing stupid stuff. I say occasionally because we all do stupid stuff on occasion as traders. The more you learn about your own psychology, the psychology of others in the market, and we all, for the most part, have a shared psychology. And as I forget who said it, but someone said that trading is an uphill swim against human nature, paraphrasing. And it really is. A lot of trading goes totally against your normal psychology, and that's something that we've talked about quite a bit. I think we all have pretty much a shared psychology when it comes to markets, and that's a little difficult for some people to wrap their head around. Now, when it comes to neurology, we all share the same neurology. We all have a brain sloshing around up there. And we actually have 2 brains. We have the old brain and we have the new brain. And the old brain, or the so-called lizard brain, which looks like a lizard brain, is underneath that thing on the left. That keeps you alive. So if there's some imminent danger, it takes over and sort of hijacks the rest of your brain, because you can't sit around and think, if you're in a dangerous situation, whether or not you want to leave. It's a flight or fight type of situation. And of course, the rest of what's sloshing around up there makes you you. Now, the lower level of the brain can make you do some stupid stuff because it's very impulsive by nature. And it has to be. If a cab's getting ready to hit you, you have to jump out the way. The rest of your brain shuts down. But in other situations, such as the trading world, that can often make you do dumb things. One of my clients sent me a little video on YouTube, and it's just kind of a hippie guy with these little cookies, little animal cookies or whatever, talking about the 2 brains, and he says that your lower brain is kind of an a-hole, you know. Anyway, the great thing is, as you understand a little neurology, is these impulses that come from deep down in your brain that could get you into a lot of trouble. You can sort of subdue those and let the rest of what's sloshing around up there take over, because it only takes a couple of seconds to get from that brain to the other brain. And that can keep you out of a lot of trouble. As I said, ad nauseum, Greg Morris gives the example of when he was in his fighter pilot training. He was in the simulators, and the job of the instructor is to make you crash that simulator and make you freak out in the simulator, because it's a lot less consequences if you freak out in the simulator than if you freak out in the air. And they're trying to wash you out of flight school because they only want the best of the best to be fighter pilots. And they got to Greg quite a bit, And he came to the realization that he was going to have to figure out some way to be able to stay in flight school and not freak out over all the bells and whistles and alarms or whatever's happening. And what he came up with was to wind the clock. And they had these little analog clocks. I actually bought an airplane clock I keep on my desk and try to remember to wind the clock every time I make a trade, or right before it at least. Anyway, that was his way of making a little bit of a pause, so he takes a more of a whole brain approach and not an impulse approach to doing the wrong thing. And when he got into hairy situations up in the air, did the same thing. He'd wind a clock. And then in future years, when he became a airline pilot, he would sort of metaphorically wind the clock by touching the dash in a dangerous situation. He talks about situations before, like losing an engine and things like that, where he tells the co-pilot, settle down, let's not shut the engine down. He touches the dash, takes a deep breath, and then is able to take more of a whole brain approach. So, well, that's all my time. I want to thank you guys and girls for watching. Again, follow-up information, DaveLandry.com/StockCharts for the slides and a bunch of other stuff. You need to reach me, DaveLandry.com/contact. So again, thanks for watching, and may the trend be with you.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.